Hey everyone, in today's video, we're going to continue with our series talking about different tax hurdles that you will face in retirement and how Roth conversions can help you overcome those tax hurdles. In today's presentation, we're going to be talking about a specific tax hurdle that applies very broadly to married couples. Okay, and it's a tax hurdle that's created when one spouse passes away. And so we're going to be talking about how Roth conversions can help you avoid the IRS's widow penalty once one spouse passes away in a given couple. Okay, now before we get into it, if this is your first time on our Safeguard Wealth Management YouTube channel and you like this video, you like our content, first off, don't forget to hit the like button, but also hit the subscribe button. We release videos weekly. You'll be notified of all future videos that we release. Okay, so let's get into it. Let's talk about what the widow penalty is and why you need to avoid it in retirement. I find one of the hardest parts of tax planning just in general is that it's very difficult for people to wrap their heads around certain parts of tax planning. Because with tax planning, you're not only trying to overcome hurdles that you'll see in the next 1, 2 to 5 years, but also hurdles that you might see 20 to 25 years away. Okay, and this again is something that it's difficult to wrap our heads around because most of us automatically think, okay, if this is an issue we're going to see 20 years from now, that's an issue we can deal with 18 or 19 years from now. But this has to be something that's dealt with at the beginning of retirement, even though it's 20 to 25 years away. And again, this can be a hard part to wrap your heads around with tax planning, but it's extremely important that we plan for the entirety of your retirement at the beginning, okay? And so let's get into talking about what the widow penalty is. And so this is going to be a situation every couple faces. And on the screen right now, I have just a picture of a forward-looking tax graph. Okay, you'll see here that we have the tax brackets mapped through time. Notice they go up over time because of inflation. The tax brackets adjust to inflation. We have some tax changes here because of the Tax Cuts and Jobs Act. If you don't know what that is, click in the right-hand corner of this video. We just recorded a video on that a few weeks ago. Okay, and notice we see this person's situation. They're filling in their income need through time. These green bars here are RMDs that push their essentially tax liability up. And then we see over here, what's this on the right side of the screen? All of a sudden, we see another adjustment in the tax brackets. Now, is this some tax raise sometime in the future? And the answer is no. This shows when one spouse passes away. Okay, and what happens when one spouse passes away? Well, there's a lot of different adjustments that happen. For one, you go from the married filing jointly brackets to the single filers brackets. So we can see here in the middle of the screen, married filing jointly, and then the single filers brackets over here on the left. And you'll notice that essentially the single filers brackets are cut in half. Okay, so when one spouse passes away, essentially that surviving spouse is going to go from a very forgiving tax system in the married filing jointly system to the single filer system. So essentially the space that they have in each bracket is cut in half. Now, typically we see when one spouse passes away, the surviving spouse's income goes down. But it doesn't cut in half. It goes down a little bit because, again, you're going to be spending less on groceries, probably traveling less. There's all of these different expenses that are going to be cut or at least minimized a little bit more. But you're certainly not going to see your income cut in half. You still have a mortgage or a house expense that's still probably going to be very similar to when you were married. Okay, notice as well in this, on the standard deduction, the single filer standard deduction here is about half of what the married filer's deduction is. So again, basically what happens when one spouse passes away is that surviving spouse is going to see more of their income taxed at higher rates. So they're going to lose certain tax benefits. The other thing that's very important to note are Medicare increases. So essentially, if you report too high of an income, you're going to see your Medicare costs increase. Now, the married filing jointly system here is very forgiving. And just so you know, this is based off adjusted gross income, so you have to add the standard deduction back in. But essentially, if you're married, you can take up to $176,000 of reported income and still pay the base Medicare rate. Notice what happens with the individual filer system, though, the single filer system. Once again, we see it cut in half. And so most people will not be subject to the married filing jointly Medicare increases. But if a spouse passes away, they may be subject to the individual or the single filers Medicare adjustments. And just so you know, this applies to both Part B as well as Part D premiums. Okay, and so what we'll see is both tax penalties because of Medicare increases will often go up, as well as the tax liability just in general will go up, even if that surviving spouse lowers their income. And so oftentimes when we're running someone's plan, we run it based off normal life expectancy and obviously increasing that for the future. And so in a given scenario, we might have it where the male in the couple might we might estimate they might live till 90, the female to 94. And so this widow penalty that's created, they might only be subject to for 4 years. Again, this would be in our base case model. But we also know that life doesn't unfold that cleanly. Not everybody lives to normal life expectancy. There are situations where one spouse passes away in their 70s. And so this creates a situation where now, rather than being subject to this widow penalty for 4 years, they might be subject to this widow penalty for 20 years. And so again, this is why it's important to always stress test your tax plan. Okay, and look at, okay, what happens if we don't live to normal life expectancy? If someone passes away early, what will that do with this widow penalty? Okay, and let's look at how important, how costly this widow penalty can be. So let's say we have a married couple. Okay, the couple is the same age, just for simplicity reasons. And this couple has a taxable income need of $70,000. Okay, but they have an additional RMD on top of that income need of $72,000. Okay, so their total taxable income is $142,000. Okay, and they were in a situation where they didn't deal with RMDs early in retirement, and now we're going to see what happens when you add in this widow penalty. And so this total tax liability is based off federal and state taxes, and it's based off Wisconsin state taxes. So it might change a little bit based on where your home state is and what the tax liabilities might be, but regardless, this will show will show as a great illustration. So their total tax liability is $32,600 for having this taxable income of $142,000. Okay. Now, what happens when one spouse passes away? Now, typically, when one spouse passes away, the primary beneficiary on their retirement accounts is the surviving spouse. And so that surviving spouse will still have the same RMD if they're the same age, because they'll essentially inherit those the deceased spouse's accounts and have the same RMD. Well, in this situation, we're going to say this widow needs $20,000 less of income. Okay, they're going to be traveling less, expenses just in general will go down, but they're still going to have the same RMD of $72,000 over that income need. And so their total taxable income is going to be $130,850. And notice you'd expect it to go down by $20,000. But remember, their standard deduction is cut in half as well. And so we see their total taxable income fall, it doesn't fall by as much as you would think it would fall by. And so now what we see, just from a tax standpoint, their total tax liability goes from $31,300 up to $34,000. Okay, but then we also see some Medicare penalties as well, because they're going to go from the base cost here, and they're going to see 2 step-ups. I believe it's actually 3 step-ups in their case, okay? And so they're going to notice their Part B and Part D premiums rise by $3,500. So if we add those together, $34,000 plus essentially $3,500, they're going to have a total tax liability of $37,500, over $6,000 in extra taxes because of this widow penalty. And so this is something where if they're going to be in this situation for 20 years, that can really start adding up. 6,000 times 20, and then obviously discounting it for present value, that can really start to add up. Okay, and so how can they overcome this? Okay, well, we could see at the beginning of their retirement that they would face these situations over here. Okay, we see that this widow penalty over here is going to be very costly. This widow penalty could even move sooner if someone passes away. But notice at the beginning of their retirement here, they have a lot of tax room for conversions before RMDs start. And so this is something where they could be filling in this tax room here at the 22 and 24% rate in order to avoid 25 and 28. So that makes sense just because of the Tax Cuts and Jobs Act. But also we see it make even more sense because of this widow penalty over here. And they could even fill in higher over here into the 24% bracket as well. And so Roth conversions at the beginning of retirement, not only to plan for RMDs and lower these RMDs later, but also plan for this widow penalty, which might be 20 to 25 years away, but nonetheless is a huge expense, as we saw given their situation. So again, we can see how Roth conversions can very clearly help avoid this widow penalty. Again, this is going to be a situation that every couple faces at some point. Now, they might only face it for a year or two, but nonetheless, they're going to face it. Another couple might face it for, again, 15, 20, 25 years. So this is something that you want to know what your forward-looking tax plan looks like in order to know if the widow penalty is going to be a real concern going forward in the future, to know if you should be performing Roth conversions today. Now, if you don't know if you're going to be subject to this widow penalty, reach out. Go to our website at www.safeguardinvest.com. Fill out our contact form. We could certainly have a retirement expert help you through this forward-looking tax plan, deciding if Roth conversions make sense, deciding if this widow penalty will be a real concern. always remember, you don't need more money. You need a better plan. You need a forward-looking tax plan that plans for and avoids this widow penalty. If you like this video, hit the like button. Don't forget to subscribe to our channel. Again, always remember, you don't need more money. You need a better plan. Thanks for watching.